Hello, my friends. Today is September 2nd. My name is Joseph, and this is Markets Weekly. This week, we're going to talk about three things. First, we're going to talk about what's going on in China. There's a very interesting article released in the Wall Street Journal this past week, which gives Xi Jinping's perspective on how to take care of the Chinese economy, and it's very different from what I think many Western commentators are thinking. Secondly, we have to talk about what's happening in the labor market. This past week, we had a lot of interesting data on the US labor market, and it looks like things are slowing, but in a good way. And lastly, I want to talk about the US dollar. Now, over the past several months, I've had a positive view on the dollar, but that just doesn't seem to have been working. But I'm going to go over what is happening in other countries and why it suggests to me that maybe the time for the dollar to shine has finally arrived. Okay, starting with China. So just to set the stage, as we all know, the Chinese economy has not been doing very well. There's a couple reasons for this. One, of course, China had very big lockdowns, more than anyone else, and they had some trouble restarting their economy. And secondly, there's been significant stress in the real estate sector in China. So real estate is a really important asset. It's widely held by the Chinese households, and it's a big part of the economy. So what's happening right now is real estate prices are going down, so a lot of households are feeling squeezed. They borrowed a lot of money to buy real estate, hoping that the real estate prices will continue to go up forever, but they're not. And so now they're stuck with underwater properties. That is to say that their properties are worth less than their mortgage, but they continue to have to pay mortgages. So that's crimping consumer confidence. And of course, when a big part of your economy is about building real estate and real estate prices are going down, that means there's less building going on. Now, that being the problem, many commentators have expected that China would just embark upon some huge stimulus to try to restart their economy. That seems to be what the government has done over the past few decades. Whenever there is a slump, the government will basically just spend a whole bunch of money, build a bunch of buildings, build bridges, build stuff, whatever. As long as they're building stuff, then they are creating jobs and they're creating GDP and so forth. So that was the anticipation, but that's just not happening. Another common perspective is that Western commentators are thinking that, Chinese government been on this investment-driven growth model for some time, but obviously that's not sustainable. You can only build so many buildings, you can only build so many bridges. The underlying economic value of that infrastructure investment is never going to be worth more than a debt, and so it's kind of a waste. So you obviously can't do this model forever. What you gotta do is you have to be more like the Western countries. You have to transition into a consumer-driven economy like the US. So in the US and in many other countries, the economy is largely driven by consumer spending. So US businesses produce and sell to US consumers. In contrast, of course, a lot of the Chinese economy is driven by just big investment projects taken on by the state. So that was the perspective of many commentators. Now, this recent article in the Wall Street Journal by Lin Wei gives us insight into the thoughts of President Xi Jinping. Now, President Xi Jinping appears to have released a speech to the public that he gave earlier in the year. The release appears to address a lot of these comments from foreigners and other policymakers as well. What struck me from the article is two things. One is that Xi Jinping doesn't really believe in just spending a whole lot of money just to get them out of this economic slow patch. Now, if you look to what the US is doing and many other Western countries, when they had a slow patch, what they would do is they would just print a whole bunch of money and spend it. A couple years ago, for example, in the US, the US government gave a lot of stimmy checks. People who are in debt, well, let's say, forgive your student loans or at least pause them. And the same thing for many mortgages as well. That seems to be the playbook in the West. When you have economic troubles, government just, opens up the money printer and just kind of makes it go away. Now, President Xi says that we're not going to do that. if we have a debt problem, and we do, of course, we borrow too much money to buy all this real estate and other investments that aren't working out. If we have a debt problem, the answer is not to do more stimulus. The answer is to tighten your belt. The answer is austerity, which actually is pretty much what your grandparents would have told you and what many Western policymakers would have thought not too long ago. If you recall, not too long ago, when we had debt problems in peripheral Europe, the answer that the Western governments gave to Greece, for example, is austerity. You have too much debt. The answer is not to spend more money. The answer is to tighten your belt, spend less. Now, it seems like President Xi thinks that, this is important. Otherwise, you just get lazy people. And obviously, this experiment that we're doing, that whenever we have an economic slow patch, we just spend money rather than tighten our belts, is something that's really new. And maybe it isn't sustainable. Obviously, you just can't keep spending and spending and borrowing and spending forever. And so he doesn't want to go down that path. And maybe in the long run, he's right. I guess we'll find out. And the second thing that he noted, it was that he doesn't really believe in the Western consumer-driven model. That is to say, he doesn't seem to want to transition the Chinese economy to a consumption-driven model like it is in the US. Now, there seems to be a couple reasons for this. One is that if you, let's say, give people a lot of stimmy checks, you don't actually know what the public would do with it. What if, for example, the Communist Party gave their publics a bunch of money and the public just hoarded it instead of spent it? Well, then that doesn't seem to be that productive for stimulating the economy. Instead, if you give the money to state enterprises, then you have more control over how the money is spent, and maybe that's a better way to stimulate the economy if he decides to. Now, there's been some limited stimulus, but I think what they're saying is that there's not going to be the big stimulus that you've seen in the past. Now, a related point is that maybe the reason, or one of the reasons why President Xi is not so keen on turning into a consumption-driven economy is that it also has political economy implications. If you give more money to the public, you're basically giving more economic power to the broader public and to the private businesses as well. And that economic power probably has to come at expense of the state. And if you recall, not too long ago, we had a booming tech sector in China, and then the government cracked down on it and sometimes made some important people in the tech sector seemingly disappear. So having a very strong consumer-driven economy might be at odds with having a one-party state. And so that might be another reason why the Chinese are not keen to transition into a more Western-style consumption model. All in all, this is to say that many Western commentators may not be looking at this the right way, and so there may not be big China consumption. And what we see, slow, modest growth in China, in part due to lack of stimulus and big debt overhang, like in the case of Japan, might be something that might persist for the coming years. Okay, now let's talk about what's happening in the US labor market. So this past week, we had a lot of interesting data on the US labor market. It began with the JOLTS. The JOLTS data is something the Fed has been paying attention to. It shows the amount of job openings in the US. Now, if you look at a graph of JOLTS data, you'll see that job openings available just surged higher post-2020. Everyone was looking, all the businesses was looking for workers, and they just couldn't find any. But also notice that the JOLTS data shows a steady decline in job openings. So the level of openings is still historically high, but it's come down a lot. That shows that businesses just don't need as much labor as they did earlier a couple years ago. The big boom, the huge labor shortage that we've been talking about seems to be softening. And that is also, of course, that is also seen in other data. If you look at quits rates, which is another good sign of labor market strength, you'll see that quits rates are basically down to where they were pre-pandemic. Now, we think of quit rates as a good indicator for labor strength is because when workers have confidence, they just quit their job. They don't like what they're seeing. They just quit their job and they go and they find a better job elsewhere. when a labor market is strong, you would expect quit rates to go up as everyone just goes to look for a better job. Now, quit rates has normalized, showing that the labor market has also normalized. Now, we had really big important data on Friday. That's the non-farm payroll, and it shows also that the labor market seems to be moderating. Now, job growth still seems to be pretty strong,
187,000.
but what was notable is wage growth has basically softened to about 0.2%, and also the unemployment rate ticked up to 3.8%. Now, when you look at the unemployment rate ticking up, sometimes it's because there's less demand for labor, but other times it's because there's more supply in labor. And what we're seeing now is labor participation rate ticking up. So even as there seems to be less demand for labor as the available job openings decline, we see that in JOLTS, there's more and more people looking for a job, so higher labor participation rate. So, now you take this and you look at it and it suggests soft landing. More people coming to work, increase in supply of labor, and a slight decrease in the demand in labor. This also suggests that economic growth will continue to be strong because the supply of labor is increasing. And if you have more people working, obviously, as an economy, you'll continue to grow. This also makes the Fed's job a lot easier as well. As we have more people participating in labor force, wages are probably going to come down a bit. And that suggests, from the Fed's perspective, that we could have inflation come down smoothly. Now, I still think we'll probably have one rate hike before the end of the year, simply because the economy continues to grow very strongly. But that's not necessarily true. And in any case, it does suggest that at most, based on what we see today, and data could change, the Fed is really, really close to being done with their hikes, and they would probably start cutting sometime in the second quarter of next year because inflation has come down. Okay, and the last thing we'll talk about is the dollar. Now, if you look at the US dollar index, you'll note that it strengthened significantly last year, then it came down. This year, it looked like it was breaking down not too long ago, but now it seems to have stabilized and it's hitting resistance at a key level. So what's happening with the dollar? So my view was always that the dollar was going to strengthen significantly going forward based on what I understand how monetary policy works. So throughout the Western world, we have a big inflation problem. So everyone is hiking interest rates. Now, here's the thing. The effectiveness of interest rates depends on how your financial system works. For example, in Canada, you hike interest rates, and then over time, a lot of the people have mortgages that renew basically every 5 years. So when you hike interest rates, very soon, within 5 years, you have people who are have to renew their mortgages and start paying higher interest rates on their mortgages. And that's going to impact their spending, and that's going to slow the economy down. And of course, the Canadian economy, real estate is a big part of it. In contrast, in the US, you can raise interest rates. And from the consumer side, well, everyone is locked into 30-year mortgages, and so they're not really that much affected. At the same time, of course, there's a lot of other things happening, but that's one thing as well. Now, if you look at the Eurozone, they have something like what's happening in the Canadian economy. Some Eurozone countries have short-dated mortgages, but they also have a lot of other things going on as well. For example, their financial system is a lot more bank dependent. So when you hike rates, one of the things that happens is that banks lend less money. Part of it is because banks are worried that, interest rates have gone up. They don't want to lend money to someone who won't be able to pay the loan back. But also, of course, there's less demand. Fewer people want to borrow when interest rates are higher. So that's the banking channel. In Europe, almost all the loans are made by banks. The banking sector is the predominant provider of financing. That's not the case in the US, where the largest provider of financing is actually the capital markets. So when the banking sector is not lending, that doesn't have as big an impact on financing in the US because the capital markets are still open. If you're Google, if you're Apple, or if you're any large corporation, you can still show up in the bond market and issue debt. So when the Fed raises rates, if you're in the Eurozone, it really crimps your financing. In the US, a lot less so. And we're seeing that play out finally. So this past week, we had data from Canada showing that, well, the Canadian economy appears to be shrinking. So they had negative growth of about 0.2%. The market saw that and immediately began to price out rate hikes from the Bank of Canada, thinking that as the economy there goes into recession, maybe the Bank of Canada is done hiking, maybe they start cutting. Now, if you look at the Eurozone, of course, not only do they have credit drying up, but they are also hit with a big energy shock, which has in some ways receded, but in other ways, not fully. Now, there's some interesting data from the ECB showing that for industries in the Eurozone, those that are highly sensitive to energy, well, they are still not doing all that well. So you have a double whammy of high interest rates, but also this energy problem there. And it's finally feeding through, and it seems to be impacting their economy meaningfully. Now, if you look at their PMI data, now PMIs have not been a great indicator of the cycle, but just as a reference, looking at their PMI data, it's been trending towards pretty dire situations. And if that persists, you can also see that the ECB stop hiking and maybe move into cutting mode. Now, what stands out among all this, of course, is the US. Economy continues to grow strongly, and the Fed is still contemplating one rate hike. Monetary policy simply is not as effective in the US as it is in other countries. So going forward, I'd expect this differential between the US and other countries to widen. And that, in my view, is a strong tailwind for the dollar. And I would not be surprised to see it continue to strengthen in the coming months. Okay, now that's all I've prepared for today. Thanks so much for joining. If you're interested, please check out my blog at feddiag.com for latest thoughts on markets. And if you're interested in learning more on how to understand markets, check out my courses at centralbanking101.com. Thanks so much, and talk to you guys next week.